Alright, today's bank is Comerica Incorporated. It's based in Dallas, Texas. It's a very, very big bank, about $80 billion of assets. So that's about, what would that be, about 7 times the size of our average bank that we have. So a really, really big bank. So we can go over to the stock page here, and we can see it's about a $7 billion market cap. It's pretty big, pretty large amount. And we see the trend of the pricing, as we've seen from the charts that we've looked at up until now. We usually see this up and down, and then up and down, and then the market sort of decides, is it going to go down further, or is it going to go up? And it looks like Comerica's gone up. And so that means that the investors perhaps have found some value in the company since year to date. So now it looks like the price earnings is about 11. I believe that's about a 9% earnings yield, which is a little bit on the low side. So the price of the earnings is a little bit more expensive than the average bank. Pretty good dividend yield there, 5.09%. If we go over to the statistics, we can see some of the more valuation measures as well. Price to book 1.31. That's a little bit on the high side, so a little bit expensive for the net assets of the company. And if we look at the return on assets, we have 0.82% return on assets, which is on the low end. We normally see somewhere between 0.8 and 1.05%, so a little bit on the low side of the range, and return on equities pretty average actually. So we've got a perhaps a little bit lower profitability bank, and also the pricing on those earnings is a little bit higher than for most banks. So once we dive into this, maybe we can see whether that pricing makes sense, whether it's too expensive, whether the earnings are enough. And we'll also look at some of the risks to see, is it a high quality bank, and do we have a reasonable expectation for a continuance in the net income that it's currently making, right? All right, so we're at the balance sheet now. We've got a little over $5 billion of cash, and that's about a little over 6%, so that's pretty good. Most of the banks we have in our database are up to about 6% in cash. That's a pretty good amount. As well as the securities go, we've got $16 billion, and that's about 20%. That's on the high side. We normally see somewhere between 10 and 14%. So 20% of securities plus about 6% of cash gives us a pretty good liquidity position. Most of our banks, or the average bank in our population, doesn't have that amount of liquidity on their balance sheet, so that's good. And we need to keep in mind that these amounts are in millions, so typically we're working in thousands, but this is such a much larger bank that we're working on millions here. So anyway, so as far as the loans go, we've got about $50.8 billion of loans, and an allowance there that nets about $50.1 billion. That's about 64% of assets. So that's a little bit on the lower side. We typically see somewhere between 68 and 67% for loans. So they're a little bit more allocated toward cash and to securities than they are to loans, which would mean that they have a little bit more liquidity and less risk on the asset side, at least credit risk type stuff. But on the income statement, they might have a little bit less interest income because the higher yielding assets are the loans, right? So if they have more securities and cash, then they would have a lower yield. And as is the case right now too, cash yields a higher amount than most banks' securities portfolios. So there being a large amount of securities on their balance sheet possibly means that they've got a lot of low yielding assets. And we'll see a little bit more of that once we get into it. So anyway, total assets of almost $80 billion. That's a lot of money. Really big bank. So then we've got liability side. As we usually do, take a look at the non-interest bearing deposits, which is almost $26 billion. That is 35% of the liabilities, and that's fantastic. We want as many as of the non-interest bearing deposits as we can get. For the average bank, we see somewhere between 20 and 24% non-interest bearing deposits, so this bank has 35%. These are a costless funding source, and in a lot of ways can be a revenue generator, right? If the customers need to pay service fees on their deposit accounts, right? Anyway, so then we've got some interest-bearing deposits of almost $38 billion. That's about 51%. That's a really low amount of interest-bearing deposits. And then as far as the actual debt, we've got about $7 billion. Looks like they paid off about $3.5 billion, somewhere between last quarter and this quarter. So down to $7 billion, and that's about 9-10% of the balance sheet, or the liability side, which is a little bit on the high side of the range of what we see most banks have allocated to debt. But really, such a large allocation to non-interest bearing deposits really probably makes their interest expense be pretty low compared to most banks. They also have some preferred shares, about 400 million. These aren't publicly traded. And I did look at the agreement in the 10K, and these are rate resetting preferreds. So I believe the rate resets July 1st, 2025. So that would mean at that point, so up until now, the preferred dividend rate has been at a fixed rate, 5 point something. But on July 1, 2025, it's going to become a floating rate. So at that point, it's going to reprice into a much higher rate. So just keep that in mind. It's only about $400 million when we're looking at, $73 billion on the liability side, and they've got $400 million that will reprice. That's not a very material amount, but just something to realize and expect. So coming down to the income statement, we can see there's about $1 billion of interest income. That's a lot of money. That's about 5.7% yield on assets, and that's really good. That's higher than the range of what we normally see right now, which is fantastic. And that links into what it actually contradicts a little bit of what we were discussing earlier. Oh, I see what might be happening to cause that. So we were thinking the allocation to securities having a higher allocation to securities would make the interest income be lower, right? But then we come down here and it seems like the interest income's pretty good. What's going on? Well, actually, the bank is pretty leveraged, it appears. So the assets to equity is about 13 times. So the assets divided by the equity is about 13 times. And that's a pretty high ratio. We typically see somewhere between 10, 11 times for that ratio. So they are pretty highly leveraged compared to most banks. So then that means they've got more assets. Even though the allocation to securities might be a little bit less, overall their assets is a lot more, which is giving them a lot more interest income. But then on the flip side, that means that they would have had to borrow a lot more money to get that leverage up, right? So then that means that the interest expense is perhaps likely to be a little bit, it's probably actually about average. So if there's a more higher allocation to non-interest bearing deposits, but they're a little bit higher leveraged as well, so those two things maybe perhaps cancel each other out. But if we look at the interest expense, we can see 471 million. That's about 2.66%, which is actually about an average amount of interest expense, if not a little on the high side. So we can see that the deposits actually are a pretty good yield. So 317 million out of the deposits is about 1.99% yield. That's pretty cheap right now. So, that's evident from the non-interest bearing deposits being so high. But anyway, so if we take an average interest income and an average interest expense, if not a little bit on high side, it puts our net interest income about 548 million, which is a 2.76% net interest margin. Now we typically see somewhere between 2.8 and 3.2% net interest margin, so 2.76% is a little bit on the low side, but not too far outside the range, so we've got a net interest margin that's a little bit leaning lower than the average bank. So then coming down to the non-interest, we can see that is 236 million. That equals about 19% of revenue, which is really good. We typically see something like 10 to 13%. So 19% is some pretty good money. That's because they've got a lot of ancillary services that they can earn a little bit extra money that the smaller banks might not be able to do, right? And from the non-interest expenses, we've got 600 million, which represents about 48% of the assets, and that's higher than we normally see. So we typically see somewhere between 42, 47%, something like that. So this is 48%, a little bit higher, not egregiously higher, but it is higher. And $600 million is a lot of money, and their net interest income was only 548. So basically, the entire amount of the net interest income is consumed by the non-interest expense, and then leaving. It's kind of a probably not a good way to look at it, but to look at the scale, because those aren't necessarily one-to-one related, right? But just to kind of see the scale of the non-interest expense, you can maybe view it that way. So 534 million revenue plus 200 million revenue minus the non-interest expense leaves only about 138 million. But then you've also got some preferred stock dividends, right? But that doesn't end up equaling a whole lot of money. And so even when the preferreds reprice in 2025, it's not going to affect the income statement that much. Anyway, so the common shares are left with about 131 million, and that is about 0.66% of assets, which is a really low amount. We typically see somewhere between 0.8 and 1.05%. So, this quarter, they had a pretty tough go of it. And that's interesting because you can see last year they had 317 million. Their net income has been split. Net income this quarter is about a third of what it was last quarter. And a lot of it is due to the net interest income, because the interest expense went up way more than what the interest income did. So that leads me to think that perhaps the balance sheet is a little bit liability sensitive, and so that's resulted in their net interest income getting squeezed, and so then they're making a lot less money on the income statement. So anyway, we're looking at a 0.66% return on assets. And if we were to compare this 131 million to the market cap, which was about 7.4 billion, that puts us at about a 7% earnings yield, which is really, really low. We usually want to make at least 9 to 11% on an average bank, right? So already I can see that more than likely we're not going to want to buy the bank. We want to buy banks that we can get an appropriate, reasonable yield on, right? First and foremost is the quality of the bank to us. Like we're buying the company, not the stock, right? So that's the mindset that we have. So we look at the risks, the interest rate risk, the credit quality risk, as well as the capital adequacy and liquidity. And we want to buy a bank that has reasonable risks for all those things, and that we can feel pretty comfortable owning the bank, right? And then as well as a bank that is profitable, and so all those things connect together to where the risks tell us how likely is the current profitability going to continue forward. And so we look at the bank from that perspective before we even consider price, right? We want to buy a bank that's profitable and that we can expect it to continue being so. Then we consider whether the price we have to pay for all of those variables is appropriate for us, right? And we're looking for base hits. We're not looking for home runs. We're not looking for the really troubled bank that's no one is wanting to buy and that we feel like we're going to knock it out. There's a small chance we could knock it out of the park, right? We're looking for the good banks that are making good money and have all of their risks appropriately contained, and that we can buy that bank for a reasonable price. That's it. Anyway, so let's go down into the footnotes and we can learn a bit more about what's going on with the bank and whether its risks are reasonable. So they start out with the fair value measurements, which is interesting. So we normally compare the carrying value, which is the amount that is on the balance sheet, and we compare it to what the actual fair value of those assets are. Usually the only things that have a difference in fair value and carrying value would be the loans and held to maturity securities, which the bank doesn't have any. So the only thing we have for Comerica is the loans that would have a difference, and it looks like it's about a little over $1 billion difference, which isn't too bad at all. It's only about 18% of equity that we would decrease. So the $1.1 billion that we would change is about 18% of equity that would decrease sort of the price to book ratio type stuff. So we normally see something between 25 and 40% reduction. So 18% is a really, really low amount. So that's fantastic. That tells us that perhaps the loans that are on their balance sheet are more short-term, short-duration loans, or that their interest rates are more aligned with the current market prices for interest rates. And we'll learn a little bit more about that once we get into other things. But so if we convert everything to fair value, from carrying amount to fair value, and we compare the net assets, so the assets minus the liabilities at fair value, we can do a ratio of the market cap of the bank. So the market cap of the bank is 7.4 billion, and the net assets after we convert to fair value ends up being about 4 billion, while also excluding goodwill. It makes our price to book at fair value at about 1.97 times, so about 2 times. So you would be paying double for the fair value of the bank's net assets, or the company's net assets. And that's a pretty reasonable price right now. It's about average, right in the middle of the average. We typically see 1.5 to 2.5 times for the fair value of the net assets for most banks. So it's a very average price. And even if for most of the banks that are being acquired by banks, they're paying about 2 times the net asset value. So very average price. And also if we take the net assets, so assets minus liability, basically the equity at its fair value, and divide it by the assets at fair value, we can also get a ratio that tells us a little bit about the capital adequacy, right? Basically the fair value of equity, common equity ratio, and that's about 5.3%. It's pretty average as well. We typically see somewhere between like 4.5 and 7% for that ratio. So a little over 5% would tell us that their net assets and capital is about as adequate as the average bank is, which is interesting because we saw that it's a little bit more leveraged than most banks are. So, but then when we convert things to fair value, they are a little bit better capitalized compared to other banks. I guess the balance sheet seems to be fairly leveraged just looking at the amortized cost of things. But when converting to fair value, their loan values aren't as lower as other banks are compared to their carrying amounts. So it puts them at a reasonable capital adequacy position. And that's why I like doing this conversion, because it puts apples to apples. If you just looked at the price to book ratio and didn't consider the types of loans on the balance sheet, or the durations or the interest rates, and you didn't consider the difference between the way the accounting works for held to maturity securities or available for sale securities, you would be comparing apples to oranges, right, in your price to book ratio, because it could sway the price to book ratio one way or the other depending on one bank calculates and presents things one way and the other bank presents and capitalizes things the other way, and it makes you misinterpret that ratio, right? So converting things to fair value puts them all in a little bit more apples to apples. Of course, there is some estimation uncertainty here. You know, the loans are level 3 investments, which means it's a really, really big estimate as far as what the value of those loans are. So that, you know, could be either way, but I feel like it gives us a better approach to considering capital adequacy as well as the valuation that is placed on the company as a whole. Anyway, let's carry on. So we've got the investment securities. We can see most all of them are mortgage-backed securities. We also have some treasuries. So that means this entire portfolio is riskless. That makes things really easy for us from a credit quality standpoint, right? So the bank has no allowance on the securities portfolio, and it seems like that's appropriate since they're all guaranteed by the U.S. government, either explicitly or implicitly. So that's fantastic. We can also see the duration or the term structure of the securities portfolio. We can see most of them are at least 5 years out, and actually most of them are 10 years out. So we've got some securities here that mature way far in the future. So that presents some repricing risk for us. If interest rates were to go up, we would be trapped into these lower rates for 10 years or more. So that would not only decrease the value of these securities, but it would also leave us trapped into lower yields on them while other banks are buying securities at the higher yields and making a lot more money than us, right? So that's our risk that we take here. So now let's get into the loans. So we've got here some business loans and then retail loans. The interesting thing about this bank is that it's almost all commercial loans, right? It's about 92% are business loans, commercial loans. So a lot of the risks and returns of the bank are dependent on the businesses in the area. And so a lot of them are C&I, so 26 billion here. And then next in line is commercial real estate. So the C&I ends up being about 55%. That's a really, really high amount. It's probably 3 times what we would see for most banks. So they have a very big C&I loan practice. And they also have a pretty low residential mortgage side of things, which I like from an interest repricing risk perspective. They don't have those 30-year fixed mortgages on their balance sheet, which I feel like presents an enormous amount of risk for being trapped into low risk interest rates for a really long period of time, right? So the business loans, C&I type loans, reprice a lot faster. So as interest rates go up, or as they're able to reprice those loans into the higher current market yields, right? And the amount of commercial real estate loans is about average, if not a little bit on the low side. So principally, the loan portfolio is most all C&I, and then next in line commercial real estate mortgage, which is about normal for most banks. But we can also see here the credit quality metrics. So we've got the accruing and past due 153 million plus non-accrual loans, puts us at about 370 million past due, and that's about 0.73% of loans, and is a pretty average amount. And then if we wanted to calculate a non-performing assets, we could add the non-accruals to the 90 days or more past due, and that gives us 217 plus the 32, which is 249 million. And that's about 0.49% of loans, which is a pretty average amount as well. So we can see, like, at least from the non-accruals and the past dues, that we've got a pretty average amount of credit quality currently in the book. Now we can also get down into the credit quality indicator. Unfortunately, they lean more on the criticized loans. We, in our analysis, look more at the classified loans. So criticized loans include special mentions as well. Ours in the classified loans only includes the substandard and doubtful, which I feel like gives us a better idea of what are the major risks, right? And special mentions are important for sure, but it skews the loan quality to a point where it looks like there's a lot of bad loans, right? But that's not necessarily the case, and it doesn't signify, of course, the loss given default either. So anyway, so there's sort of nothing that we can do with the criticized loans because we don't have the data in place to be able to assess it, whether it's too high or too low. We don't know because we haven't pulled it from the other banks. I wish they had published classified loans as well, which is what most all banks do. So they really left that out of the equation. But when that's the case, then we lean a little bit more on the non-performing loans, the past dues and non-accruals. And for what we've seen, they've got a pretty average amount of past dues, non-accruals, non-performing. So then we would more look to see that the allowance should be about average as well, right? For average credit quality, we would want to see an average reserve. And what we have here is 728 million. and that's about 1.43% of loans. And that's a really high amount. We typically see somewhere between 1.10, 1.25%. So the bank has 1.43% of its loans reserved for. And those have already been recorded as an expense in prior income statements, right? So with us having such a large percentage of the reserve for the loans, it makes me feel pretty good about the loan provision not needing to be beefed up in the future, which would hit our income statement, right? It would be an expense on our income statement. So I feel really good about the credit quality. It seems like the portfolio itself, there's not a lot of past dues or non-accruals, but it also seems like they have a good enough reserve in place, a very conservative reserve, right? So that's fantastic. We can get into more of the derivatives now. The derivatives is one of the things I don't like, or their policy or what they've done with the derivatives. So if we come down here, we can see that they have 32.3 billion, excluding the foreign exchange contracts, which are fairly immaterial anyway. It's about $32 billion of derivative hedges that are basically fixing the rates that they receive. So, as I've discussed in other videos, I prefer the hedges to go the other direction where it's receive floating, especially because banks over the long term are more liability sensitive, right? So this basically fixes the asset side of the balance sheet and forces it to be more liability sensitive. And of course the risk management, the ALCO of the bank knows more about the term structure of the loans and securities and debt than I do. But I can see on the call report the repricing timing of everything. And as we know, the securities, which is about 20% of their balance sheet, have maturities at least 10 years out, right? At very low interest rates. And so that's a repricing risk, right? And we haven't seen the structure of the loans and how they come through either, but $32 billion of hedges to fix interest rates in an environment where interest rates are increasing, or the market price, the market yield for loans and securities is much higher than what they have on their balance sheet, I feel like is a big risk and perhaps not a good idea. And I believe I saw in the recent 8K that their chief risk officer retired recently, or his last days will perhaps, or his tenure will end December 31st of this year, perhaps something like that. So, but anyway, this is something to keep in mind when we look a little bit more at interest rate risk when we get down to that part in the MD and A. But as it is, their loan portfolio is $50 billion, and they've got $32 billion of hedges here. And actually the way this would work, based on cash flow versus fair value hedges, is this $24.5 billion would hedge the asset side. So it turns floating rate loans into fixed rates. And then the fair value swaps would be on the liability side. So this turns floating rate liabilities into fixed rates. Fixed rates into floating rates. So on both sides, it increases their exposure to a market of higher interest rates. that really makes me a bit nervous. Anyway, so we can look at that in conjunction. We can look at the repricing timing as a whole with all the bank's assets and liabilities to figure out, does that make sense? All right, so let's keep going here. Another thing to think about is they've got about $29 billion of unused commitments to extend credit. That's about 58% of their loan portfolio. They've got $50 billion of loans, and they could possibly need to loan an additional $30 billion. I mean, they're definitely not going to have to. I mean, that's not set in stone, and the customer's not going to borrow that much. But that's interesting because it's a lot higher than most banks. Most banks, somewhere between 20 and 30% of their loans is an unused commitment. But for this bank, it's about double that. So, depending on the liquidity position and the capital position of the bank, that might create some strain if an excessive amount were drawn down. But that's a consideration we can make once we get into the liquidity and capital, but something to remember to think about when we get there. Now we're into the debt. They've got a lot of different notes in place, so it makes it a little bit complicated to try to piece it together. But they've got FHLB advances here of about $3.9 billion, and some of them mature next year, and then some of them mature over the next 4 years. So that's our repricing perspective there. They also just issued about $1 billion of notes. These are fixed to floating. They become floating in 2029, so that's sort of our repricing date there. At that point, it'll be a little bit more expensive, but it's interesting to see this because you can see what are the market prices for debt now. All these that are currently on the balance sheet and for most banks are for pricing from back in 2020 to 2022 perhaps. So now we can really, since there was a recent issuance, we can see what are the rates now for the debt for these types of banks, and we can see it's a little bit higher. So that's our risk with repricing, right? It's like this bank that reprices in 2025, that's next year. When that happens, if the bank needs more funding, they would have to reprice it up at the 6% level, presumably. So even though the Fed might be talking about, or various news agencies might be constantly pounding us with rate decrease, still the rates in the market are a lot more right now than what the rates are for these balance sheets that we're all looking at. So we still have the risk of repricing, and we want to make sure that the bank is at least neutral or a little bit asset sensitive in its repricing risk, right? Anyway, so we've put all this together, and we can make these considerations once we get into more of the repricing risk. But yeah, so we can keep going on. Another interesting thing to think about is this accumulated other comprehensive loss. So we don't typically look too deeply at this, but this is such so much red here that I felt it is important to touch on. So all this stuff doesn't hit the income statement currently, but it could, right? And a lot of it probably will. And at that point, it will become recognized as a loss. Part of it is the investment securities. So they have about a $2.2 billion loss in their investment securities. And their portfolio is think 16 billion, something like that. So that's a large percentage. And given the low yields on the securities currently, and we also saw the duration of the securities is pretty long as well, at least 10 years. So they're trapped into those low rates for a long time, and they could have these losses sitting here for that period if they're going to hold them to the end of the maturity date, right? If they're going to sell them before, they're going to have to record some of this loss here. So that's a lot of money, especially when you consider that the net income for this quarter was, what, 131 million? Yeah, 131 million is the net income for this quarter. If they sell a small portion of their securities portfolio, that entire net income for that quarter is gone, right? And then, the hedges as well is a big one. So $817 million loss. How we were talking about all the swaps are received fixed, right? But interest rates keep going up. So there's big losses built up in those swaps that they're slowly trickle into the income statement as whatever's being hedged on the income statement works its way through its duration, through its maturity, right? So these will eventually land in the income statement. That's 817 million. Remember they had 131 million of net income this quarter, so that will hurt. And then pensions, they've got $400 million loss in the pensions sitting here in accumulated comprehensive income as well. So and it even tells you, we expect about $400 million of losses to hit the income statement within the next 12 months. They had 131 million net income this quarter, right? So, part of the net income for the quarter is composed of some of this OCI that's reclassified into the income statement already. So it could turn out that it doesn't really affect the continuity or a big change in net income year to year, but it's just interesting to see how much money is sitting here as a loss that hasn't yet hit the income statement. So that's just something to think about as far as the profitability goes as well. And then they also note that there's some lawsuits going on. They don't really go into big detail about specifically what's happening. They do say that they're under investigation by the CFPB. I don't know how that would turn out. Typically it ends up where a bank would be required to provide subsidies and outreach to disadvantaged communities. So it ends up costing them a little bit of money to remedy those findings, but it doesn't mention what's going on, where it is, or what they expect the result to be. They also say that there's some other stuff happening, but nothing specific, and so it could end up costing them anywhere from $0 to $202 million above what they've already accrued for, which I don't know how much that is. But remember this quarter was 131 million of net income, so 202 million is a lot of money. Not to say that would be the end, what would end up being the exact cost, right? But there's a cost, some range, because of all these things that we have to take into consideration when we're considering the risk that the earnings that they're currently making will continue forward, right? And then they do a little bit of segmentation type stuff, and now we're finally in the MD&A. So I usually like to compare this quarter to the same quarter of last year, so this one here. So looking at this, we can see that The loans are yielding about 6.33%. That's really good. That's a great yield actually. And the securities about 2.12%. Wow, that's really low. I mean, that's way below what we normally see right now. I mean, typically we're seeing at least 3% yields on securities, so that hurts, and that's maybe a lot of why there's such big losses in the securities portfolio currently, unrealized losses. So anyway, as we mentioned, they're basically trapped into these yields for at least 10 years or so, so that's a pretty big risk, especially as someone can go out and purchase a similar security for a lot higher yield currently. So they're missing out on that yield that other banks are getting. So that puts them at a yield of 5.2% on earning assets. That's about average, if not a little bit on the low side. But, remember, well, this is just on the earning assets, right? So earlier when we were looking at the income statement, comparing it to the balance sheet, that was based on all the assets. So that makes the yield be different than this. Anyway, so then coming down into the interest expense, we can see that the money market and interest-bearing checking deposits about 3.18%. That's where most of at least the earning deposit, interest-bearing deposits are coming from, $28.7 billion. It's a pretty high amount. Currently we would see something like 2 to 2.5% on the average bank at the most. So 3% is a pretty high amount, and then the time deposits seem to be pretty much in line with what we would normally see. So it's a lot of these more money market deposits that are making it expensive, and then the debt seems to be about what we would normally see as well. So that puts their interest-bearing yield at about 3.9%, which itself is pretty high, but that's just on the interest-bearing sources, right? So remember, we've got a lot of non-interest-bearing, about 35% of the liability side, so that helps too. So the ratio of interest expense to all the liabilities would be a lot lower than, it'd be about average or lower than the average bank. And so all that together puts us at a net interest margin of about 2.8%, which is it's on the low side. We would want to see somewhere around 3%. Most banks are somewhere around 3% these days, and you can see that it was there last year, the same quarter last year. So over the past year, their interest expense has skyrocketed, while the interest income didn't increase as much, and so that maybe corroborates a little bit where we were concerned about them being a little bit more liability sensitive, because the liabilities increased by a lot more than the assets. So that gives us even more concern about the way that the derivatives they have in place are making them overly liability sensitive, and it's making this risk to where they're just getting squeezed on the net interest income, which isn't that unusual for most banks, but in this case they're already pretty low profitability bank, right? So we really want to avoid anything that could risk it becoming less profitable. Anyway, so that's the major thing that I wanted to look at here. There's also discussion of the liquidity and the capital and the interest rate market risk, which we can look at together. So we can see here as far as the capital goes, they've got pretty good regulatory capital ratios. So leverage ratio a little over 10, Tier 1, common equity Tier 1. All these ratios are pretty good. So I think that corroborates a little bit with what we were talking about earlier, where converting everything to fair value puts them at a pretty adequate capital, as well as they're a little bit more allocated toward lower risk assets like cash and securities. So all those things keep these ratios up. And a little bit on the credit risk, we talked about that in detail as well. And a bit more in detail of each specific category of loans. Okay, so now we're down into the liquidity and market risk. I want to learn a little bit more about how much ability they have to borrow from the FHLB. Okay, it's right there. All right, so let's talk about the interest rate risk first, and then we'll get to that. So, okay, so we can see that, yeah, they're defending their position on the derivatives, and we can see, they talk about what we've already talked about, $16.3 billion of securities at 2.12%, pretty long duration. That's a big risk for interest rate repricing. But we can get down to their projections for changes in net interest income. So increase interest rates by 100 basis points decreases their net income by 3%, or net interest income by 3%. And then if it goes up 200 points, that decreases by 3%. So that's not as big. It almost seems fairly neutral. It would be a little bit liability sensitive, right? But it's a little bit neutral. And so we've done some of our own calculations of this based on our review of the call report and everything. And so we can talk a little bit more about how the securities reprice, the loans reprice, the deposits reprice, the debt reprices, and figure out, whether those things make sense, and also taking into account the direction and materiality of the swaps currently. So as far as the securities go, we have, as we talked about, more than probably 85% of the securities portfolio reprices at least 5 years from now. So that's about $13 billion that we're earning, 2.10% yield on, which is super, super small. And we're trapped into that for at least 5 to 10 years, maybe more. So that's a big risk to us. But fortunately, it looks like the loan portfolio, 84% of it reprices within the next year. That's really, really high amount. That is almost 3 times the percentage that we would typically see for most banks. And that must be why they have such a large amount of derivatives in place to counteract that repricing. Yeah, so that's $42 billion of loans that reprice within the next year. And they have $32 billion of, not all of it is repricing the loans. I think $24 billion was repricing the loans. So they've hedged about half of that. So that would put about 40% of their loans repricing within the next year. If you consider, the hedge is taking care of half of them. So that puts them more at a, still on the high end, but at least not so egregiously high of loans that reprice. But also something to think about is that they, banks are naturally liability sensitive. They're dependent on deposits, right? So, but fortunately, this bank has about 35% of their deposits are non-interest bearing, so it doesn't reprice right. There's presumably the case that they could migrate into interest-bearing accounts as customers decide they want to earn a yield on their checking account instead of nothing. But as it is, much of their deposits are non-interest bearing. So if we take into account the money market savings accounts, the ones that are interest bearing, plus the time deposits that mature in the next year, that gives us about 59% of the liabilities reprice within the next year, or 59% of the deposits actually. And so that's about $36 billion. So then that actually puts us where I believe how much loans were $42 billion of loans, but actually 37 billion of deposits, and plus about $2 billion of the debt reprice. So actually, by taking on the derivatives, I know I didn't present that clearly, but like there's basically $43 billion of assets that reprice in the next year. That's the securities plus the loans, 43 billion. And then there are about 40 billion of liabilities that reprice in the next year. So that's actually fairly neutral on its own. So $43 billion of assets, $40 billion of liabilities, pretty good match, and actually a little bit asset sensitive, which I like anyway. But now that's not taking into account the derivatives. All of a sudden, when you throw in that there are, $32 billion of fixing the asset side of things, that puts them in a really, really, really liability side sensitive balance sheet. And I feel like that's a really, really big risk, at least in this environment of current market prices for securities and loans and debt is much higher than what's currently on their balance sheet, right? So, yeah. So we put that into perspective. I think that creates a very big interest rate repricing risk. But of course, internally, they know much more about the timing of things and the market than I do. But that level of risk makes me a little bit uncomfortable. Anyway, so let's keep going. So sources of liquidity, great. So I usually look at this in combination with liquidity and capital. So as we talked about, they bring on a pretty good amount of cash, right? About $5 billion. And they've also got a really good sized securities portfolio, about $16 billion. And about half of those securities are pledged. And so that leaves about $8.5 billion. So the on-balance sheet liquidity for the bank is about $13.6 billion. So that would be the cash plus the unencumbered securities. And that represents about 21% of deposits, which is fantastic. That's a really high liquidity ratio. And so when we take into account that they can also borrow from the FHLB and the Federal Reserve, we've got 13 billion, 18 billion that they could borrow in addition to what they've already got. And that gives them some off-balance sheet liquidity. It's a source that they could borrow from if they need it, right? And when you add all that together, that gives them about $50 billion. Also taking into account loans that could still be pledged to get additional liquidity here. So they've only pledged about 85% of their loans, so there could be some more that they could possibly get of liquidity. It's just not as liquid, I suppose. But anyway, so that gives them a ratio of about 80%, about 79% of deposits. That's a really high ratio. We typically see somewhere between like 70 and 80%, so 79% on the higher side. So it leads me to believe that the bank is fairly liquid and in a really good capital position. We also talked about how they converting to fair value, they've got a lot of net assets as well. So that's what helps them have the borrowing base and collateral to be able to borrow from the FHLB and the Federal Reserve Bank as well. And we did see that they have a pretty high amount of commitments. I believe it was 58% of the loans could be drawn down further. But they've got an outsized amount of liquidity compared to most banks. If you did a ratio of their liquidity to the commitments, it equals about 151%. This is including what they can borrow from the FHLB and Federal Reserve. So, it's on the lower side of what most, it's probably about a third of what most banks would have in place as that ratio. But it is at least comforting to see that, they have enough liquidity that they can draw from to support those commitments if they were to be drawn down. But they've got pretty good credit ratings as well. And finally, speaking a little bit about the deposits, we looked at the call report to see what's the uninsured deposits amount, how much of the deposits are brokered, that sort of thing. About 48% of the deposits are uninsured, which is a little bit higher than we typically see. We typically see 30 to 40%, something like that. So 48% is a really high amount. But we did see that they've got a lot of liquidity in place to perhaps mitigate some of that risk. Also, they have a lot of brokered deposits as well. About 13% of their deposits are brokered, which is about double what we typically see. And that might be why some of the deposits accounts or time deposits were a little bit more expensive, because you got to add a little bit higher cost for the broker, right? So that makes higher costing deposits, and so those things are a little bit higher and a little bit risk for deposit flight compared to most banks. But Comerica has a really good liquidity position, it seems, as well as adequate amount of capital, so I'm not too concerned about that. So this gets us to the end of things. They've put together some common ratios as well that basically reiterates a lot of what we have already talked about. And this gets us to the bottom. So we can now maybe bring all these things together and try to figure out a conclusion and how does it all fit together, and whether there's reasonable or unreasonable risks or price or profitability, etc. So let's start with the profitability. We saw that the bank is lower profitability than what we typically see. It's about 0.66% of return on assets, and it's mostly because over the past little while, or over the past year, they've been squeezed on the interest expense side, and it's decreasing their net interest income compared to last year, and it's really decreased their overall income and puts them in a position to where they're not as profitable as the average bank. So speaking a little more towards some of the risks and our considerations of whether that earnings can continue forward into the future. The first thing we can maybe talk about is the credit risk, a good one. So the credit risk seemed to be good. There were pretty low non-accruals, pretty low non-performing, pretty low past dues, and although they didn't present the metric that we usually consider in our analysis, I feel pretty confident that looking at the past dues and non-accruals, it was pretty evident that they've got a pretty good quality loan portfolio, and also the reserve that they have in place seemed to be a lot higher as a percentage of loans than what we'd see for most banks. So I believe it was 1.49%, somewhere around there, so that's a really high ratio of loans. So I feel pretty good that the loan portfolio is or at least the reserve is conservative enough to cover any current losses or future losses in the loan portfolio. So then our risk for the provision needing to be increased in the future is muted compared to most banks. And so that makes me feel good that the net income should not be at risk as a result of credit quality. Now, interest rate risk, on the other hand, we talked a lot about that, and I was pretty pessimistic about it. Mostly due to the derivatives. I feel like the asset liability structure, repricing structure, at least over the next year, was perfect naturally with the bank. The amount of assets that reprice in the next year was maybe a little bit more than the assets that reprice than the liabilities that reprice in the next year, and that puts them at a slight asset sensitivity position, which is where I prefer it to be. And if they had just left it alone, I would have felt really, really good about it, right? However, they have about $32 billion of cash flow hedges that basically convert a lot of the bank's assets to fixed rates and a lot of the liabilities to variable rates. And what that does is make it to where if interest rates go up, they get squeezed, the net interest income gets squeezed. And we've already seen that that's happened, right, over the past year. And the net interest income is a lot less than what it was last year because of that. And now I feel like they're still in this liability sensitive position by their own doing, right? Maybe there's a reason they can't unwind the swaps, or maybe that's they know more than I do about the internal asset liability position. But as it seems to me, the interest rate risk is too high, especially when currently market yields are a lot more than what's on their balance sheet currently. So once all of the liabilities reprice and assets reprice, then they're going to be repriced at higher yields, and that's going to decrease the net interest income further than what's already been decreased, right? And from looking at the other comprehensive income, we could see there's already a pretty big loss. I think it was about $800 million built up into the derivatives that's sitting in equity but hasn't hit the income statement just yet, but it will if interest rates continue to keep going up, right? So I just feel like we already have a less profitable bank than average, and now there's this big risk that it could become even less profitable due to the net interest income getting squeezed, the potential for net interest income to get squeezed due to all those derivatives they have in place. So I don't like the interest rate risk. The capital risk I feel really good about. They have a higher amount of liquidity on the balance sheet than what most banks do. Their regulatory ratios are great, and even by converting the fair value of the assets and liabilities converting the assets and liabilities to fair value puts them at a really adequate capital position as well. The fair value of the net assets divided by assets gives them a common equity ratio at fair value that's pretty much in line with the way that most banks are positioned currently as well. So pretty good liquidity position, pretty good capital position. I don't see any issues with there. There's some risk in their deposits as far as a higher than usual amount of uninsured deposits and broker deposits, but I feel like they've got enough liquidity in place to where they could draw on additional funding sources to shore up whatever deposit flight they could end up having. So all that together, it seems like, first and foremost, we buy high quality banks. So that means, banks that are earning good money and that we feel like those earnings will continue into the future. And what we have here instead, I think, is a low earning bank, and also that is at risk due to the interest rate risk of its earnings being decreased even further. So I don't think that we would buy the bank at all. There could be a price that someone would be willing to pay, but I feel like it would have to be a price that far exceeds what the average bank is being traded for, right? But currently we have, if we were to compare the bank's earnings currently to the market price, I believe it's about a 7% earnings yield. And that is really, really low. Most banks right now are having an earnings yield of somewhere between 9 and 11%. So that's not a price that I would be willing to pay for the average bank, much less a bank like this that is earning less money and that is a big risk of continuing to earn less than that going forward. So I'm going to say a no on this, but that's definitely leave any comments you have below and let me know if I'm on the right track or if you agree or disagree with what I have concluded or any of the data that we looked at. Love to hear what you have to say about it, and yeah, thank you for listening.